Office real estate's definitely facing some structural headwinds, but a lot of people liked real estate, especially as an asset class, long-term appreciation, cash flow, and very tax efficient. And that's going to dovetail us into another good investment here that provides a lot of the same benefits. And it's oil and gas working interest. And so this is kind of, I'd say, not talked about nearly as much as real estate, and it's not as big as real estate from a total addressable market perspective. But for those entrepreneurs making over $1 million a year of taxable income, paying hundreds of thousands of dollars of taxes per year, then the oil and gas may be something they want to explore. So what are your thoughts on oil and gas overall? And then I'll break down the Internal Revenue Code, the tax benefits, and then kind of some examples of how investing in oil and gas working interest works.
A couple things that are great about oil and gas that you're going to get into some of the weeds and the details on is the tax benefits, because you can use write-offs and offset ordinary income, W-2 income, and a lot of investments may create tax benefits, but you can't use it against active income.
Yep.
And that's a huge part of oil and gas. It's going to be around. If anyone asks, fossil fuels will be around for a long, long time. There's just no way to meet all the energy needs with any other source. And obviously there's other sources that will come online over the next, 3, 4, 5 decades. But fossil fuels and oil and gas is still going to be an integral part of energy in the world for a long, long time. What I would say about oil and gas, and we'll get into this a little bit too, is not letting the tax tail wag the dog, because just like QOZs that we talked about on a previous call, if you look at all the tax benefits and you put money in a QOZ that turns out to be a bad investment, then it doesn't matter. The tax benefits you will forget if you lose your money for a bad investment. Same thing's true in oil and gas.
Yeah, I totally agree. So let's frame this up from a tax perspective, and then we'll go into the return profile and the commodity risk and how it performs. So Section 469 of the tax code is really what bifurcates active versus passive. And normally, if you're making a passive investment in something like oil and gas, and this is true for real estate or other assets, you can't take any losses to offset non-passive income, essentially. But 469C3 specifically carves out or makes working interest in oil and gas exempt from this rule. Now, the requirement is and this is little known, but the investor must be a general partner or have unlimited liability to claim the deduction. So that is one downside, is you must have liability exposure. And we're going to talk around how you would want to get around that. And really, just at a high level, you would want to do that by being a general partner in the fund, which means you have unlimited liability for 12 to 18 months until you capitalize and get a lot of these different IDCs or intangible drilling cost deductions. And then you can flip to a limited partner afterwards. So a lot of the funds that we're looking at will have that built in. So again, 469C3 is the section of the Internal Revenue Code that essentially says, okay, if you invest in oil and gas wells, despite not being an expert or not doing that and materially participating, you can take these losses to offset your other income. So that's the first building block. The next building block is underneath Section 263C, and this is what allows working interest owners to deduct something called intangible drilling costs, or IDCs, in the year incurred. So think of this as like labor, fuel, chemicals, drilling mud, site prep, all of that kind of stuff that has no salvage value. You can write all of that off in the year that is incurred. You don't have to write it off over time. And typically this is going to be 70 to 80% of your cost. So again, that said another way, if you put in $100,000 and your IDC percentage is 75%, that's a $75,000 tax deduction in year one. At a 35% tax bracket, that's going to be worth $26,250. So my real amount at risk is the difference of $100,000 cash invested minus $26,250 of tax savings. $73,750 is my net basis at risk here. So that is the juice on the front end from a tax perspective. Help clean that up. What did I miss there?
No, I think that's exactly right. And in addition to that, you want to make sure that it's a good investment, as I said. I remember one time many years ago, we were sitting around a group of friends and we asked, what was your best investment ever? And one of the guys said that he used to have a cocaine habit, and he was at Bobby McGee's restaurant, which used to be here in the Phoenix area, doing cocaine, and this guy pitched him on an oil and gas deal. He forgot all about it, that he had signed up and that he wrote this guy a check or something, gave the guy money. And he said that he was still, and this was like 20 years later, he was still getting checks every month from this oil and gas deal. So that's not to say that when you're high on cocaine, you should be doing oil and gas deals. But the point being that he got so lucky, because when you invest, he invested in a single oil well. And when you invest in a single oil well, if that thing's dry, you lose 100% of your money. And if that thing flows, you could have what happened to this guy, which was by sheer luck. So make sure that you're diversifying within oil and gas. And the other thing I see in oil and gas is sometimes people get pitched these, like I have this magic way of finding where the oil is, and then I flip it and sell it to these oil producers for a multiple, and you're going to have this huge return. Just like in QOZs, I like dependable, reliable, experienced operators who've been running oil and gas as a real business for a long time, not startups, not people who are doing some cute, clever thing with oil and gas. Stick with the reliable, predictable, experienced operators.
Yep, I can't agree more. And just to hammer that tax benefit home, right, as we're talking about these IDC deductions, this can offset W-2. This can offset business income, short-term capital gains. There's no passive loss limitations on here, no income phase outs, no cap. And so we got a quick chart that we're going to put up here that just shows that intangible drilling costs in the oil and gas working interest of the year one deduction, and compare that against real estate. If you buy if you buy a residence, you depreciate that or write that off over 27 and a half years. That's a 3.6% per year deduction versus, again, 70 to 80% intangible drilling cost deduction year one for oil and gas.
What about like cost segs and stuff like that? How would you throw that in there?
Yeah, cost segs, it depends on if it's a personal kind of a residence or if it's a commercial, but you're going to be usually 20 to 30% or so. So, if you're cost segging, then you're going to be at 20 to 30% instead of the 70 to 80% here.
Yeah, makes sense.
Definitely juices more. The other benefit, though, is you also have, kind of similar to depreciation, you have depletion. And so there's a safe harbor depletion in section 613 of the code. And really what that says is anybody who's an investor can take a depletion deduction for 15% on the gross income from the well. So if this well, let's say, produces $10,000 a year of income, right, from the royalties that's spitting off to me, I only have to claim as taxable 85% of that, or 1 minus the 15%. So that would save me, some more taxes there. So it's kind of like depreciation in real estate, but it's called depletion when it comes to oil and gas. So not only do you get that huge upfront deduction, you also get this annual depletion deduction that you get to take out of any of the income that's coming out.
Yeah, one other thing on oil and gas, many times these are sold by people who have broker dealers or broker relationships, and they get spiffed money up front. And I usually see 6 or 7% of the capital put in. So you put $200,000 into an oil and gas deal, and your advisor made $14,000 that you don't see that goes through the broker dealer. And the only reason I mention that is incentives are critically important when you're making decisions, and you want to be careful when you're working with someone who is getting paid on things like oil and gas, because they may oversell it the way we sometimes talk about life insurance salesmen oversell it because they make really nice commissions. Same thing with oil and gas. Sometimes that gets oversold, and you might have an advisor who could get 1% from a portfolio, or they could get 7% up front. They're getting 7 years of payments on day one by redirecting some of the capital into oil and gas. So just be aware of that out there.
Yeah, and that's a great dovetail into the next chart that we're going to put up here, which is a comparison of different risk factors and mitigators. And so here we're going to just break down commodity price exposure, operational exposure, liquidity, fee structure. You talked about that. That's a big thing you want to consider. Tax law, and then the GP liability. Again, a big thing to note here is that when you're investing in these working interests, you cannot own them in LLCs, domestic asset protection trusts, or any type of creditor protected vehicle, because if you do not have that exposure of the unlimited liability, then you cannot take those losses to offset your non-passive income. You can still take the losses, you'll just be able to only offset passive income. So that's really what unlocks this. And so you can see here that the GP liability, now generally, unless there's different fund structures here, but you're going to want to make sure you've got liability protection, umbrella policy, and you're going to want to make sure that within the actual subdocs in the private placement memorandum and the operating agreement, you can convert from a GP to an LP after you get all those working interests rocking and rolling, you take those tax deductions. And so that way, when you flip to an LP, you now no longer have that unlimited that unlimited exposure. So again, big caveat from a tax perspective, you must have this unlimited liability to take the losses to offset non-passive income. A lot of people miss that. So make sure you have a lot of insurance, or that the fund has a lot of insurance to protect the GPs, right, in case there is a lawsuit. And then make sure you then do convert yourself to an LP once you've squeezed all of the tax juice out of it. So then that way you can just collect your passive royalties.
And what you just said is so good, Bryce, because I don't hear people talking about that when they talk about oil and gas. And Mimi and I, as you know, are invested in oil and gas. We actually got a distribution yesterday from our our oil and gas, which
Your
is
first distribution?
no.
Oh,
It's been regular.
that's good.
It's been good.
That's good. Yeah.
I like our oil and gas investments. I will say though that we don't need the income right now. We're just accumulating for the future. So I always have mixed feelings when I get any kind of distribution. I don't really need it, but it's nice to know that it's doing well and they're paying some people out.
Yeah, that is always good. And I think the important thing, like you said, there's not just the tax tail wagging the dog, but also making sure that you're diversified in different oil fields. You want to make sure that that's important. You're understanding at what commodity price in terms of where is oil and gas in terms of the shale or whatever it may be that it's producing. What is the commodity price there? What's the break even based off of the economics of the specific fund and where they're drilling and what's going on there? And then also, I think from a portfolio construction, right sizing the allocation within your portfolio. And so I know when we look at commodities, which this would fall in kind of that commodity or that real asset section within the Billionaire's allocation, we normally see between 3 to 10% in this holistic asset class. That includes mostly oil and gas. It may include infrastructure. It may include timber, agriculture, farmland, etc. So I think from a right sizing of a portfolio.
Gold and silver.
Yep, exactly. And even crypto now, we're seeing kind of from that allocation. So again, it depends on your risk tolerance, what you're looking for, but a nice uncorrelated income stream with some heavy tax benefits. That's how I would describe it.
Yeah.
All right, let's talk through the actual application here. And so it's going to be a case study. And this is going to be here, let's call this entrepreneur Marcus. So Marcus sold a SaaS business for $25 million after taxes. He's generating $2 million annually in ordinary income, board seat, real estate, consulting, etc., paying $700,000 a year in taxes. And so Marcus wants to build out over time a 5% position of his, and so 20 out of his $25 million is liquid. And so he wants to build a 5% position of that $20 million, which is a $1 million allocation to oil and gas. Attracted to the uncorrelated income stream, attracted to the tax benefits, and everything that comes with it. So instead of just writing a check for $100,000, what would be optimal here is building out what I would call an oil and gas ladder. And what this would do is give you different vintages. And what I mean by vintages is every year you're making a different investment in an oil and gas investment. You want to be diversified within that bucket of which providers, which drillers, et cetera, are you investing in, but also you want time diversification because the price of crude and the price of the underlying commodity is going to ebb and flow over time. And so the value and the production of these wells is going to ebb and flow based off of that commodity price. And so here we're going to show a visual that just shows, let's assume you go back to 2024. Let's assume that's when Marcus started making his first investment. You can see here he's got an investment for $100,000 a year for 10 years. So 10 years times $100,000, that's $1 million of investments. If we assume 75% intangible drilling costs up front, that means he gets a $75,000 tax deduction per year. At a 40% tax rate, that means he's saving $30,000 per year or $300,000 in taxes over the 10 years. And then you can see his net cost really is $700,000 or so. So that's his basis. So again, kind of we talked about building maybe a bond ladder, building different income ladders. It's really smart to do that to get access to different vintages within oil and gas. And is this something that, as you and Mimi are allocating capital to, are diversifying your vintages too?
Yeah, most definitely. To me, I think of, because of the term, vintage is wine. Because you may have one winemaker and they may have an incredible 2019 and maybe their 2020 isn't nearly as good. And so what do? They have all these different vintages to diversify based on when the grapes were good, whether the weather was good for that type of grape or whatever they're creating. And then, of course, you have the winemaker. So similar to oil and gas, you have each year there's a different price of oil, there's a different environment, there's a different geopolitical situation. And then based on that, you may have an average provider but have a great year just because everything was really accommodating for a good year in oil and gas. So that's why you want to have a great operator, but also, as you said, diversify across vintages the same way you would with buying wine.
Yeah, I think that's a really good analogy. And in this example, for some of these funds that we like, each investment's going to be deployed into maybe 10 to 20 different wells. So each $100,000 investment that Marcus is making is getting deployed into 10 to 20 different wells. So now you do 10 vintages times, let's just say 15 wells per vintage. Now we got 150 wells that we're drilling. And so this also just is more diversification within the asset class, that instead of, hey, what if 5 of these wells are a goose egg and I'm only in 1 year? It's like, sorry, you just chose a bad vintage. Whereas again, if you're diversifying over these different times, you're just diluting the probability of striking out a lot from the oil and gas perspective. perspective.
In a way, it's a little bit like dollar cost averaging in the stock market, right? Because you don't know today the price you're buying. Will this in 5 years look like it was a high price or a low price?
Right.
But if you're doing that every single year, it works itself out.
Yep. And same with the commodity price timing, right? Because if our break even is, let's say, $40 a barrel, and we know, okay, we're getting into this vintage now, and it's maybe right now it's $60 a barrel. So we got some nice buffer. But remember, it takes a little bit of time to go from deployment of capital. They got to build out, they got to incur all this intangible drilling costs. Usually you're going to see 12, 18 months maybe before that well's really cranking. And what if you get into a huge recession? So that money you deployed 12 to 18 months ago, now maybe the price per barrel is at $45. Like there's barely even juice above your break-even period.
Yeah.
But the same thing could be said of the money you invested in that recession doesn't really get deployed or start really spitting out income until 12, 18 months down the road. If the economy's back and crushing it, price of crude's back up to $80 a barrel, you're glad you wrote that check in the recession there, because now by the time it's printing money or producing oil, things have rebounded. So there's a time lag that's really important as well as part of this.
Yeah, and I think overall in investing, consistency is really important, because I think often entrepreneurs they're overconfident in their ability to know where things are in the cycle and whether things are going to go up or down from here. And if you're not sure, have a great allocation and just consistently invest over time, and you're going to win more than you're going to lose.
Yep. And as just to educate those who have not invested in oil and gas, as a rule of thumb, the first 6 months, maybe up to the first 12 months, there's no income. That's when you're drilling and there's just the completion. And then around, maybe months 6 through month 18, you're going to have first production. So the spigot's just getting turned on and you're just starting to kind of get some income out. Around years 2, 3, 4, rule of thumb, you're going to have peak production. So that's really where you're hitting all the easy, oil. You're getting all that out of the ground, your highest distributions. And then as you have to kind of dig deeper or maybe go more horizontal, years 4, 5 through up to years 20, like you gave the case study. I mean, some of these wells do produce for like up to 20 years. That's where you could have like a gradual decline, but this income could have a very far fat tail, so to speak. So if you look at a bell curve, you could get a lot of money over a long period of time. And again, the dollar amounts you get is going to decline over time, but some of these wells could produce for decades, which it's, again, not guaranteed, but just depends on what the wells are and how successful they are.
And that's kind of the pattern we've seen. Plus our dog Abby has a fat tail, so I like to think of that too.
So we're going to go to the next visual here of, let's just take a snapshot at Marcus's hypothetical portfolio here at year 5. So we're 5 years in, 5 vintages, $500,000 deployed. After the tax savings, $350 is his net cash out. And you can see we've outlined, hey, each vintage, what year is it in, where is that in the production phase, and what could a hypothetical monthly cash flow look like, on a $100,000 investment. So this is kind of an idea of how you can see the vintages are stacking these different monthly cash flows, right, to be different amounts. And as you're rolling on and off new vintages, that income will ebb and flow. But again, it gives you more further diversification.
Right.
And then next chart we're going to show is just overlapping vintage production curves, just same data, just reframed a different way. And again, you'd have more and more vintages coming online, but it just shows that you kind of start at 0, you hit your peak production, and then you're going to have the fat tail. Now, how long is that fat tail? It really depends. No one knows, but it could be a few years, it could be decades. And that's just part of why diversifying within the oil and gas asset class is so important.
Yep, agreed.